Welcome to Trading Nation. I'm Mike Santoli. The market's about to wrap up its worst month since 2009, with many of the high-flying growth stocks really driving all that selling. The growth ETF, which is full of names like Amazon, Facebook, and Alphabet, is down around 10% on the month, while value stocks, that would be financials and healthcare, down around 6%. So should you stick with one or the other heading into the end of the year? Ari Wald is with Oppenheimer. Chad Morganlander is with Washington Crossing Advisors. I think on either side of this question, Ari, corrections in the overall market sometimes are when you see a transition of leadership, a style shift. Do you think anything like that's underway in terms of growth into value?
I think it's too early to make the call into value. I think if anything, it'll probably go into more safety groups first. But I think that's still a premature call. Listen, it's been a tough month across the board, whether you're in the growth index, you're in the value index, or in the S&P 500. All these indexes have broken trend levels. They're bull market trend levels. Now, I think we're at the lower end of what could be this new developing range, and we're momentum investors, and we're still seeing the best opportunities in more growth-oriented industries like software. The S&P 500 software industry, for instance, coming off a new high, correcting into its rising 200-day moving average, still above peak levels from January and March, the first quarter. So really just a function of the strong run-up. We can get behind that. We can defend that. On the flip side of the equation, if you look at the top weighted industry within financials, within value, it's the banking group. A lot of these value industries, they never made a new high versus where they were in January. And while I guess they held up relatively better, they fell less in October. They've broken more support levels on the way down. The bank industry, for instance, below Q1 support. So from a risk reward, we're of the view the weak get weaker. If we're wrong, we think it's actually gets led lower by value. And I think growth can hold up better.
Chad, where do you come down on this? And actually, something that Ari said is interesting. It's kind of how you define value or defensive positioning within the market. So what do you think you should emphasize here?
So you should emphasize being defensive overall. And when you have a debate about growth over value, Ari brings up some very good, strong points. What we noticed, though, over 27 years of doing this, is that when global growth starts to decelerate, that growth stocks actually are quite vulnerable. Momentum starts to break down, and you start to see growth companies have to ratchet down their future expectations in year 3 and 5 about revenue as well as earnings. Hence the reason why at this point in time, when it comes to growth over value, we would actually choose value and be somewhat more moderately overweight value. Keep growth stocks in your portfolio, but be more circumspect about the risk that you're taking. Talking about sectors now, I would be highly concentrated in consumer staple as well as healthcare. Our observation is that China as well as the European Union are decelerating. Yes, things are great here in the United States. Nonetheless, we think that you have to be somewhat more protective about where you're allocating on the equity side.
All right. Yeah, being more careful. And staples in healthcare is seemingly a different bet than saying, auto stocks and regional banks, Chad.
Absolutely.
And even for us,
without a doubt.
Yeah, what's interesting, there's some overlap in our recommendations. Healthcare is one of our favorite groups of the market. There's pockets of that within growth, too. So, really, it's just really defining where we are in the cycle. We still think late cycle, but if this does turn end of cycle, sure, those defensive areas are going to do better, but the auto names, those are the early cycle plays. I think we're well away from getting into that type of value, Mike.
Fair enough. Thanks to both of you. Appreciate you joining us today. And thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.